You were listening to Charting Wealth, the book, Chapter 7. We would appreciate your comments, any kind of suggestions you have on how to improve this chapter. We are happy to share it with you. It is on the king of indicators, the Price Percent Oscillator. Let's jump right into the chapter. The Price Percent Oscillator, the PPO as we'll call it from now on, is the king of all indicators. It is a trend-following indicator and, as its name says, an oscillator. As such, the PPO shows the relationship converging or diverging of two moving averages of prices. The PPO is virtually the same indicator as the Moving Average Convergence Divergence indicator, or MACD. Gerald Appel developed the MACD back in the 1970s to offer the ability to track momentum and follow trends. It works by turning long and short-term moving averages into a momentum oscillator by subtracting the longer moving average from the shorter one. The PPO differs from the MACD. To calculate the PPO, price percentage is used rather than dollar values. We originally used the MACD but switched to the PPO due to its ability to compare percentage changes in price rather than dollar movements. Now, simply put, the difference in calculation means the PPO is actually a percentage version of the MACD, and as such, the PPO movement in one security can be compared to extended periods of time in the same security, even when the price of the security has spiked or crashed. Additionally, because the PPO is calculated using price percentages, we can compare various PPO changes over time between stocks, ETFs, and even indexes. The PPO is calculated, or at least our PPO is calculated, by subtracting the 26-day exponential moving average from the 12-day exponential moving average. We visually depict the PPO on our charts as a dark blue line. The 8-day exponential moving average is shown as a red signal line. Now, when the PPO crosses the signal line, the crossing acts as a trigger change in price movement. It provides us buy and sell signals, and we diligently search for PPO and signal line crossovers. It's important to note that whenever crossovers occur at the extremes of price movement up or down, caution is required. Since the PPO does not have upper or lower limits, it is by default unbounded. Because of this fact, extreme signal crossovers can give false positives in determining actual price reversals. Why is this? Well, a strong move in a security can push the momentum to an extreme. What makes the PPO a viable indicator is its ability to bring trend and momentum tracking together in a single indicator. This benefit is particularly helpful with trending securities because it is based on moving averages. Likewise, attempting to use the PPO as a lagging indicator is not useful for securities that are not trending. When the PPO crosses over and falls below the red signal line, a bearish move is signaled. This action indicates the time to sell or enter into a short or inverse position. Consequently, when the PPO crosses above the signal line, a bullish move is signaled, meaning it's time to buy or enter into a long position. Crossovers give confirmation of an up or down signal. We wait patiently for confirmed crosses to occur in order to avoid being faked out by a false trend change. We don't wish to enter a trade too early, only to see the price change not confirmed by a price reversal. We also look for divergences between the PPO and price, as reflected by the candlesticks. When price moves in one direction, hits a high or a low, and the PPO does not follow suit, a signal is sent that the price movement up or down is ending or will do so in the near future. Dramatic drops or rises in the PPO occur when short-term moving averages pull away from longer-term moving averages. Such a move signals the security is overbought. The opposite is true. When the longer-term moving averages pull away from the shorter-term moving averages, the security is oversold. Please note, the value of the PPO in determining overbought and oversold conditions is limited. The relative strength index and stochastic oscillator are better suited to identify overbought and oversold levels. What's the bottom line on the PPO? We consider it a superb indicator to assist in locating trends in a security when prices are trending. That is, prices are moving up and down. In sideways sliding markets, it is not particularly helpful. As with any indicator, it's important to backtrack. Now, if you live in the U.S., you're familiar with the term Monday morning quarterback. Well, backtracking is similar. We look back in time on the charts for each period. That's the weekly chart, the 2-hour, the weekly chart, the 2-day, and the 4-hour, in order to analyze how the indicator performed in the past, as well as during the same time periods in prior years. When the indicator works, and many times the PPO is very helpful, we use it. When it doesn't work, we don't use it to trade or invest. Instead, we look for another security that we can accurately chart with it. Never forget, our goal is to do what works and thereby make excellent and winning trades and investments. Thank you so much for listening to Charting Wealth, the book, Chapter 7. Again, we would appreciate your feedback. God bless from the entire team here at Charting Wealth World Headquarters.